You have probably heard people say, the central bank raised interest rates, or the central bank is trying to control inflation. But what is a central bank? The simplest answer is this. A central bank is the organization that helps run a country's money and banking system. It is not a normal bank where you open a checking account or apply for a car loan. Regular banks serve people and businesses. A central bank works mostly behind the scenes with banks, the government, and the financial system. In the United States, the central bank is called the Federal Reserve, or simply the Fed. Think of regular banks as the stores people visit. The central bank is the control room, helping the entire system stay open and working. One easy way to understand a central bank is to call it the bank for other banks. Imagine you send $100 from your bank to a friend who uses a different bank. On your phone, the transfer looks simple, but behind the scenes, your bank must send money to your friend's bank. Banks use special accounts at the central bank to settle these payments. The central bank keeps track of which bank owes money and which bank should receive it. Think of it as a trusted scorekeeper in the middle. It does not choose what you buy or control your personal account. It helps banks move money safely between one another. Without this system, paychecks, card payments, bill payments, and bank transfers would be much harder to complete reliably. The job you hear about most is interest rates. Interest is simply the cost of borrowing money. The central bank does not choose the exact rate on your mortgage, credit card, or car loan, but it influences important rates that affect how expensive borrowing becomes across the economy. When prices are rising too quickly, the central bank may raise interest rates. Higher rates usually make loans more expensive. Some people delay buying a house or car. Some businesses delay borrowing money to expand. Spending slows down, and that can help reduce pressure on prices. When the economy is weak, the central bank may lower rates. Cheaper borrowing can encourage people to spend and businesses to invest or hire. Picture a car. Raising rates is like pressing the brake, while lowering rates is like pressing the gas. It cannot control everything, but it can influence how quickly money moves through the economy. A central bank also has an emergency job. Banks do not keep every dollar of customer money sitting in a vault. They use money to make loans and buy financial assets. Normally, that works. But imagine thousands of customers panic and try to withdraw their money at the same time. A bank may own valuable assets but still run short of cash that is immediately available. During a serious shortage, the central bank may lend money to the bank for a limited time. The bank normally provides valuable assets as security for the loan. This is why a central bank is sometimes called the lender of last resort. Think of it as the fire department for the banking system. It cannot promise that no bank will fail. Its emergency role is to stop one problem from spreading into panic across many banks. So, what does a central bank actually do? It helps banks send money to one another. It influences interest rates, which can make borrowing and spending faster or slower. And during emergencies, it can provide temporary support to help keep panic from spreading through the banking system. Depending on the country, it may also supervise banks, help manage physical currency, and provide banking services for the government. But its main purpose is simple: keep the country's money and banking system as stable as possible. A central bank does not decide what your groceries cost. It does not approve your personal loan. And it does not have a magic button that instantly fixes the economy. It works in the background, using a few powerful tools to keep money moving and reduce the chance that the banking system falls apart. That is a central bank, the bank behind the banks, helping the entire money system keep working.